Welcome to Factful Finance, where we dive deep into the numbers that really matter. Today, we're tackling something that's a game changer for your financial journey: understanding fees and expenses in investing, and more importantly, how you can minimize them. But first, did you know that fees can take a significant chunk out of your investment returns over time? In fact, a study by Morningstar found that high fees can cut an investor's returns by up to 2% a year. That might not sound like a lot, but over decades, it can make a huge difference. Let's make sure that doesn't happen to you. Before we jump into the nitty-gritty, a quick disclaimer. This content is for educational purposes only. While we'll reference different tools and resources, it's important to consult a professional for personalized advice. Now, let's break this down. Fees and expenses in investing come in many forms: management fees, trading fees, fund expense ratios, and more. Understanding these fees is crucial because they directly affect how much money you make or lose in the long run. And guess what? The good news is there's plenty you can do to minimize them. Let's start with the basics. What are these fees? First up, expense ratios. If you're investing in mutual funds or exchange-traded funds, ETFs, you're likely paying an expense ratio. This is the percentage of your investment that the fund manager takes each year to cover the cost of managing the fund. For example, if you invest $10,000 in a fund with a 1% expense ratio, that means the fund will take $100 per year to cover its expenses. Sounds harmless, right? But over time, this fee can add up. A simple way to minimize this cost is by choosing low-cost index funds, which typically have expense ratios of 0.05% to 0.2%, compared to actively managed funds, which might charge between 1% and 2%. Next, we have trading fees. These fees occur every time you buy or sell an investment, and while many brokers now offer commission-free trades, some still charge for certain transactions. Even if your broker is commission-free, there could be hidden fees, like spreads or account maintenance fees. It's crucial to read the fine print. To avoid these, you can choose brokers that offer low or no fees for the types of trades you plan on making. Let's talk about capital gains tax. Whenever you sell an investment for a profit, you're liable to pay taxes on that profit. But here's a smart way to minimize these costs: holding your investments for more than a year. Long-term capital gains are taxed at a lower rate than short-term gains. For example, if you sell a stock you've held for 5 years, you might only pay a 15% tax compared to 30% or more if you sell it within a year. So patience can literally pay off. Now let's look at an example. Meet Liam, who invested $50,000 in a mutual fund with a 1.5% expense ratio. After 10 years, the fund generated a return of 7% per year. However, the annual fees of $750, 1.5% of $50,000, significantly eroded his returns. In contrast, Sophia, who invested the same amount in a low-cost index fund with a 0.1% expense ratio, only paid $50 in annual fees, allowing her investments to grow more efficiently. It's clear that minimizing fees can have a substantial impact. But here's where things get really interesting. By avoiding high fees and choosing tax-efficient strategies, you can potentially earn thousands of extra dollars over time. A recent study by Vanguard showed that reducing fees by just 1% could result in over $500,000 more in retirement savings for someone who invests for 30 years. Imagine what that extra money could do for you. So how can you take action today? 1. Choose low-cost funds. Look for ETFs or index funds with low expense ratios. You don't need to pay extra for active management that may not even outperform the market. 2. Minimize trading. Only trade when necessary. Each trade costs you, so it's best to make your moves strategically. 3. Utilize tax-advantaged accounts. If you have the option, invest in tax-deferred accounts like IRAs or 401ks, where your earnings grow without being taxed until you withdraw them. 4. Be mindful of account maintenance fees. Some brokers charge annual fees to maintain your account. Look for options that don't come with these costs. Remember, the goal isn't just to earn money. It's to keep as much of that money as possible. By understanding these fees and taking action to minimize them, you're not just saving a few dollars, you're giving yourself the chance to build more wealth over time. And here's the thing: you're in control. fees don't have to be a hidden cost eating away at your returns. By becoming aware and making small but smart decisions, you can maximize your investment growth. What's the first step you'll take toward minimizing fees in your investments? Let us know in the comments. Thank you so much for tuning in to Factful Finance today. If you found this video helpful, why not subscribe and hit the bell so you don't miss out on more tips to help you grow your wealth. We think you'll really enjoy the next video shown on screen. It could be just what you need to hit your financial goals. See you next time, and as always, keep making those smart financial moves.